Let's take a look at the personal net worth and cash flow exercise that you've had to do, and let's go right into it here. I ask you to look at 6 important concepts, which I'll take a look at first of all before we get into the exercise. The first idea that's really important to understand is assets. Assets equal what I own, and example of those would be things like houses, stocks, jewelry, cash, savings accounts, cars, coins, any type of thing like that. Another important idea is liabilities. Liabilities basically are what I owe. Examples of liabilities would be unpaid bills, mortgages on a home, car loans, unpaid taxes. Third idea is net worth. Net worth is basically the difference between assets and liabilities, the first one minus the second one. Then we have revenues. Revenues are cash inflows, and they basically are dollars coming in, and they're usually from working, or in a business situation they would be from selling a product or a service. Number 5 would be expenses. Expenses are cash outflows, and they basically are dollars going out, and usually to buy goods and services, and for a business they're things that you need to spend money on in order to generate revenue. And then the 6th concept would be net income, which is the difference between cash inflows and cash outflows, or another way you could say that would be revenues minus expenses. Now, if the cash coming in is greater than the cash going out, then net worth goes up. And another thing I didn't mention before was net worth and owner's equity are basically the same terms. If you say net worth when you're dealing with a person's personal assets, and you say owner's equity when you're dealing with a business's assets minus liabilities. So now let's go into the exercise. First thing I asked you to do was look at that list and pick out the assets. And there are 8 assets. And the 8 assets are the house valued at $175,000, high definition TV worth $1,300, 3-year-old car valued at $9,000, gold coins worth $2,500, $500 in emergency cash in the desk drawer, stocks valued at $10,500, savings account balance of $4,000, and other personal property not listed above worth $3,700. So those are the 8 assets. Liabilities. There were 4 liabilities in the list, and they are car loan balance $4,000, balance on credit cards $1,500, mortgage balance $120,000, and unpaid IOU to brother for $1,000. Next, income and revenue items, or income items, and we had 3 of those. Wages of $30,000 per year after income taxes, interest payment on savings account of $30 per quarter, and then dividends on stocks of $60 per quarter. And then expenses. There were 9 expenses. The electricity bill, $50 a month. The doctor's office visits costing $50 per month after insurance. Property taxes of $300 per quarter. Grocery bill of $150 a week. Mortgage payment of $1,320 a month. Gasoline purchases of $60 per month. Car loan payment of $350 per month. Cable, internet, long-distance telephone services of $160 per month, and finally, other monthly expenses not listed above $110 a month. Now, net worth, or owner's equity, would be the total assets minus the total liabilities. So here's what I had. Assets, again, house, HD TV, car, gold coins, cash in the desk drawer, stocks, savings, personal property. Total assets are $206,500. Liabilities: car balance of $4,000, balance on credit cards $1,500, Mortgage balance 120, unpaid IOUs to brother 1,000. Total liabilities were 126,500, and the difference between assets and liabilities would be net worth or owner's equity, in this case, of 80,000. Next, let's look at all of the income and expense items and put them on a monthly figure and see what they come out to per month averages. So the revenue on a monthly basis and expenses on a monthly basis were as follows, or could be as follows, should be as follows. Electricity bill, $50 a month. Wages, and I'm doing this in the order they were listed on the sheet. Wages, $30,000 a year, divided by 12 months would be $2,500 a month. Doctor's office visits, $50 a month. Interest payment of $30 per quarter. Of course, that would be in a quarter there are 3 months, so that would be $10 a month. Property taxes, $300 a quarter, and you divide that by 3 because there's 3 months and a quarter, so that'd be $100 a month. Grocery bill, $150 a week times 4 weeks, $600 a month. Mortgage payment, $1,320 a month. Gasoline purchase is $60 a month. Car loan payment, $350 a month. Cable, internet, phone, $160 a month. Dividend on stocks would be $60 a quarter, and there's 3 months and a quarter, so divide the 60 by 3 and you get $20 per month. So let's see what else we have. Other monthly expenses, $110 a month. Total monthly expenses will be $2,800. Total revenues on a monthly basis would be $2,530, and it looks like at this rate the revenues or the income is not going to be as high as the monthly expenses. And so what's going to happen is that based on this cash flow situation, the net worth is going to go steadily down if this doesn't change. So we've got a $270 loss, or cash flows out exceed cash flows in by $270 a month. And so did net worth increase?